Jan 1 year, two individual taxpayers, B and L, each invested in a business activity. So both of them, they're independent and they have invested in a business activity. B actively participated in the rental of commercial property, and L was a passive investor in a cattle breeding business operated as a limited partnership. Does anything ring a bell here? When I'm reading this, does anything ring a bell? Anybody? Does anything ring a bell here? Are you able to relate anything? Passive activity losses, very good. Anything else? Yes, I have passive activity losses, but anything else within this that you have to be careful about? You remember there was a norm, there was a provision which said, yes, very good, Jasmine. I'm impressed. If I'm actively participating in a rental property, not so much that I will be called as an active participant, but little more than being completely passive. Then the provision said I could deduct $25 against ordinary heads of income, and this will get phased out every time my total income or my AGI increases $100,000. That means after $125,000, this deduction will be completely wiped off. So we are going to use that provision in individual taxation. And also we know that passive activity losses can be adjusted only against passive activity gain. So we are going to use these two provisions to solve this. Both activities sustained losses in year 2. The exhibit above relates to each activity for B and L. For each item in column A of the table below, enter the amounts in the associated cells in columns B and C for B and L. Enter all responses as positive values, and if a response is 0, please enter a 0. So the first question is, what is the amount at risk in measuring the loss limitation before year 2 loss? Okay. So they have told me that in the current year, the ownership activity for B in his individual business was 50%, and for L as a passive investor in a cattle breeding business was 10%. They both put in 10 and 60,000 respectively. They all had, from other sources, they had an AGI of 110 and 170. Their share of activity loss for the current year was 35. So this is a loss, okay? And 50. Their share of non-recourse debt is 50. For this will be 0, right? Because this is a limited partner. Okay, so this is limited liability. Okay, but they have already said that this is non-recourse debt. Okay, recourse debt. Oh, acha, this is recourse debt. Okay, this is not that, guys. This is different. This is the debt which is non-recourse. This is the debt which is recourse, and they have given it to us separately. For non-recourse debt, none of them will be liable. Nothing. And for recourse debt, only the one which somebody who's having a general liability would be accountable, not the other one. They have already told you that there was a passive income from other sources for L, but not for B. Okay, first question. They are saying before the loss for year, what is the at-risk amount for B? Can anybody tell me? What is the at-risk amount for B? So what do we do with at-risk amount? We take the percentage, we take the capital contribution, and then we add. So what is the closing balance of the capital contribution? And then we add our share of recourse liability. So this is actually an irrelevant redundant data, because this is not going to be effective for any of them. So in this case, only from partnership, can you tell me what was the at-risk basis? At-risk basis for B. So see, we don't have any idea about, so this year was in year 2 only. Okay, so this is the first year. There was no carry forward. So in the first year, now this is irrelevant for us at the moment. Why? Because we are not going to talk about this when we come to partnership. So I have cash contribution of 10. It is my cash contribution plus my share of recourse debt. Can you see this? This is my cash contribution plus share of recourse debt. How much? 10,000 and 45,000, which is for L, there is no recourse debt, and I started with 60,000. So for L, the figure will become 60,000 because it's only cash contribution. Recourse liability is 0 here. Anybody, any questions? Is this clear? So before I started, my at-risk basis was 55 for B and 60 for L. During the year, there was a loss of 35,000 for B and 50,000 for L. Now, dollars of loss. Okay. Can I knock it off? Now, this is passive income loss, guys. Okay. Can I knock it off against other ordinary activities? The answer is yes, only if it is an exception. Otherwise, you'll have to wait for any other passive activity loss before you can before you can adjust this loss. So what is the AGI now? Can you see the AGI becomes important now? Are you able to understand this? Very good. Sunita, unmute, explain. So
35,000 is a total loss and 110 is the GI. We will reduce the 5,000 and over 10,000 is allowed.
no. So the maximum that you could have adjusted against, because see, there is no other passive income, right? So ideally you should not have taken anything. But because you belong to that exception category of being a active real estate trader, so I will give you 20. But every time my figure exceeds $100,000, whatever is the excess, 50% of that excess I'll disallow. That means out of 25,000, I will disallow 20 and I will allow you 20,000. Is this clear? Is this clear? So what do we say? We say first the loss cannot be more than the at-risk basis, which is the fact here because the at-risk basis is 55, loss is 35. So the loss can come up to form 1040. But can I adjust it against ordinary heads of income? General rule, no. But this is a part of the exception which says if you're actively engaged in real estate activity, I will let you deduct $25,000 worth of losses against ordinary heads of income. But every time your AGI exceeds $110,000, 50% of that excess will be reduced from the $25,000 balance. For L, there is a total loss of $10, which is within the at-risk balance if you look at it. But can I knock it off against ordinary heads of income? The answer is only to the extent of passive activity income. Only till the extent of it's a passive activity loss, right? Because you were a partner. Because you were a partner. So now if you want to deduct this loss, so there is a loss of 50, but then I can deduct it only to the extent of 5,000 because that was my passive activity income. Can you see this? I had other heads of income worth 5,000 from passive sources. So by default, a partnership income is a passive income. I can adjust it only to the extent of passive losses incurred in our books, to the extent of other passive activity income that I have in my books. So out of this 50, I absorbed 5. Is this clear? So see, this is so easy. Out of 1 second. So out of 55, out of how much was the loss? The loss was 50 that I had. I could adjust only 5. That means 45,000 worth of losses was suspended this year. So out of dollars loss, I could adjust 5,000 and the balance $45,000 would be suspended. Similarly, here, 1 second. The total loss amount was 35, out of which I adjusted 20K and the balance $15,000 worth of loss I'm going to carry forward next year. Is this clear to everybody? Anybody questions till now? So I calculated my at-risk amount. I calculated the amount of passive activity losses that I can adjust this year and the amount that I will carry forward next year. That means as suspended passive activity losses. So I used the rental income exception that we had for the passive losses to be adjusted against ordinary heads of income. Can anybody tell me what is the amount at risk at the end of the year for B? So see, I had the 10 and 4. So 55,000 was my at-risk amount at the beginning of the year. And there was a loss that I had. 1 second. Is this clear? 1 second. Yeah, wait. Sunita, let me first finish this. Then we will talk about the other exceptions. So $55,000 was my at-risk amount. Wait, at the beginning of the year. Yes. So before we started, 55,000 was my at-risk amount at the beginning of the year, out of which my loss was 30. My at-risk amount at the end of the year becomes 20. And here, my beginning at-risk amount was 60, out of which my loss was 50. So my at-risk amount at the end of the year will become, 1 second, will become $10,000. Is this clear? So this will be 20 and this would be 10. Now first think through this question. This is such a solid question, guys. This is not an easy question. Both the question that AICPA released lately, one was this question and the other was the adjust. These are very tricky questions. With so much of data, it's very easy to get lost in the data. So what we are doing is at risk figure is what? My share of capital account and my share of recourse liability. Then I calculate what is my loss. I can absorb it in the current year only to the extent of my passive income. Any excess loss will be suspended. My at-risk amount that remains in my books for the year is my at-risk amount beginning minus my share of loss. So I have an at-risk figure of 20,000 that remains. Remember, the partnership books and 1040 are different. Okay. And remember that we said that the losses, three hurdles have to be cleared. The first hurdle is the tax basis. The next hurdle is the at-risk basis. Only if both the hurdles are cleared can I take a loss and I'll put into 1040 Schedule E. From Schedule E, whether I can knock it off against ordinary heads of income will depend on the fact whether I have other passive income or not. If no, I will not be able to absorb this loss. So your third is passive activity loss rules. So in this example, ideally, the fact that they gave you the rental activity here is such a strong, powerful thing. Okay, now we have a question here. Who is this person? Sunita. Sunita, unmute yourself. Instead of 175, how are we using this figure? We're not using at all, isn't it?
No, for calculating PAL exception for the link, if the figure is 150, then only we can get only 5.
Instead of
175. No, AGI 175. If the AGI is below 150, we can also get the exception loss here also.
Why?
Like,
no, how can you get it? Because the business is not rental activity, no. See, this is only for rental. If you look at the provision, mom and pop exception.
Sorry.
Only if you have the rental activity business, two exceptions, right? That I am having at least 10% interest in the business. And also I am actively participating, but not so much so to make me a real estate professional. And second, if I put in 750 hours in the business, I become a real estate professional. And then I can knock off everything because then it becomes an active business and not a passive business. The nature of the business here doesn't allow you to deduct anything.
Yeah, I missed it.
Yeah, but that is very important. That was the only trick in this question. Okay. So this, please be very careful. You'll be able to relate to the topic that we're discussing. You
Yes,
remember there are three hurdles. So
Yes,
this is a
ma'am.
question that is asking you, testing you exactly on that provision. There are three hurdles: hurdle 1, hurdle 2, hurdle 3. Hurdle
Yes,
1 is tax basis. Tax basis says whatever is the capital. So this is the first year that they are into business. Whatever amount I calculated plus all of the loans. So my tax basis would have become 10 plus 35 plus 50. 85 for B and 60 plus 90 for. When we come to at risk basis, at risk says whatever is amount that is at risk, only that will be considered in your loss. So then we said, okay, then for B, the at risk basis, and here what they have done is they have broken down the question into two ways: at risk basis at the beginning of the year, at risk basis at the end of the year. So we said, okay, at risk basis at the beginning of the year is going to be the amount that you put in, and plus my share of. So initially it would only be 10. Then at the end of the year, before taking care of the loss, it would be only 10 increased with my share of recourse liability, which is 45. Got it?
40. Yes, ma'am.
Same for L, it will be 60 and then nothing else. So at risk basis before the loss deduction will be 55 and 60. Is that clear?
Yes, ma'am.
Then we said, okay, how much of the loss was there? So I say, okay, the loss here is 35 and 50. Is this clear?
Yes, ma'am. The loss is
Now,
clear.
now, when it comes to stage 1 tax basis, so do I have a tax basis big enough to absorb the loss? Yes, tax basis is 85 and 10, 95. Next, at risk basis enough to absorb the loss? The answer is yes, my at risk basis is 55, but my share of loss is only 35. So
Yes,
what do? I reduce the entire loss and I push it to form 1040. Have you understood?
Okay, got it.
Then what is my at risk basis at the end of the year? I started with 10, I added it with 45 and I reduced it with 35. So my at risk basis at the end of the year becomes 50. Is that clear?
Yes, ma'am.
Now the question is, you push 35,000 to my 35,000 to knock off my AGI and reduce it and pay lower
No.
taxes.
No,
So that
ma'am.
the question is, if it's a passive activity loss, you can't deduct it against any heads of income except if it is passive activity income. Yes or no?
Yes, ma'am.
But there was an exception to this rule. Do you remember in rental activity we have read that there is a provision $1,000 of passive activity loss for rental activity can be adjusted against ordinary heads of income, provided you own at least 10% and your participation is a little more than passive. So you are an active participant and you are owning 10% in the activity. Yes or no?
Yes, ma'am.
So they are owning 50%. So your first criteria of 10% is met. And they've
Yes.
also told you that you're actively participating in the business. So you get eligible for that deduction.
Yes, ma'am.
Now the deduction says ideally it is 25,000 provided your AGI is limited to $100,000. Every time the AGI exceeds $100,000, I will take away 50% of that excess and reduce it from $25,000. Yes or no?
Yes, ma'am.
It means the moment the AGI touches $150,000, that $25,000 will become zero.
Yes, ma'am.
So this is now between 100 and 150. So if it is 110, the excess is 10. 50% of that excess is 5. So ideally, I would have been allowed 25,000 to knock off against ordinary heads of income. Now I will reduce it by 5 and I will have 20,000 that I can knock off against ordinary heads of income. Is that clear?
Got it. Okay. Got
So
it.
what I did, I said I had 35,000 as losses, which I carried forward from partnership schedule K1 to K2 my K1 and hence to schedule E. But out of that 35, I can only absorb 20 this year and the balance 15 I will push to the future years. And in future, if I have a passive activity income, then only I can offset it.
Okay.
And for L, I had my at-risk basis of how much? 60 and 0. 60. Out
Yes.
of which my loss was 50. So now my at-risk basis becomes 10. But this loss of 50, I can't knock it off against ordinary heads of income. Why? Because it's a passive activity loss. So I have to wait if I have a passive activity gain from elsewhere. So here they tell me, yes, there was a passive activity gain of 5. So I knocked off that 5 and the entire 50 minus 5, which is 50 minus 5, 45,000 of loss, I will carry it forward in future years. And if I have a passive activity income, then only I will knock it against the future passive activity income.
Yes.
Is that clear? This is a
Yes, ma'am.
very, very good question. There are 8 gradable items. None of those items are easy.
Yes, ma'am.
Okay. So the question paper might not look too tough, but remember, be very attentive in each and every question that you pick up in this area. Is
Yes.
that okay? Partnership has only 3 concepts. There can be no other concept that can be tested in partnership. Now, within these concepts, they may go a little, they may complicate it a little bit for you, but the concepts are only 3: ordinary versus separately stated item, and how these impact your tax basis. From the tax basis, how do you calculate the passive activity losses to be absorbed by the individual partners in their individual Form 1040?